Our next speaker, Mr. Sonnie Ayere, will be speaking on the topic alternative financing in a digitally enabled market. Dr. Sonnie Ayere is a founding chairman and group managing director of Dunn Loren Merrifield, a full-service financial investment house. He has over 20 years professional experience in corporate and structured finance, corporate banking, and asset management, and he works in International Finance Corporation. In 2007, he served in the Central Bank of Nigeria with the Vision 2020 Money and Capital Market Committee, and he has been actively involved in other committees, including Capital Market Master Plan in 2009 and 2014, respectively. Further to his contribution towards national service, he was also appointed between 2012 and 2014 as tax manager involved in setting up the Nigeria Mortgage Refinance Company that won Mortgage Product of the Year. I request that you help me welcome Mr. Sonnie Ayere.
Thank you very much. Good morning. I like Kevin. Kevin? The guy who just left. Yeah. Kevin Nevin, great guy. Every time I hear him speak, it's always good to see someone who comes from a different. When topic, and Tosin wants me to, how do we cook jollof? Title. And when we're talking about, thank you, about in the digitally enabled market. So I had to dig deep, go look and see what's happening, because we're knee deep in what's going on on the ground here, to see what are the things that are actually happening out there. So a lot of things I talk about are not specifically to do with the digital enabled market. It's actually more abroad, offshore. And there are reasons for that. So, but at least it gives an idea of where we can sort of get to in future. So, permit me to stop. Is this the thing I need to use for? So, yeah, it should be forward, right? Okay. So some of the topics I talked about, real estate, mainly I sort of focus on fintechs who are in the real estate sector, which is an idea that actually some people in this area interested in real estate have probably never thought about. Right? So there are quite a few fintech dudes that are actually doing very well in other parts or other jurisdictions. So we talk about that. We talk about how to partner with them, what they've done, how they actually bring markets together, construction, lending, all kinds of every aspect of the real estate market. Yeah. So let's start with this one: real estate fintech startups. I hope it's legible for everybody. Check. Second point. First one. Barriers to entries into the industry has lowered significantly because of change, because of technology. Disruptors, like we said. Cost of establishing an intellect startup, about $3 million in the 90s, is now $300 today. Then, what's actually driving the startups? REITs, which that big in Nigeria, for certain regulatory reasons also, tax reasons, and also the returns that people have gotten so far. Real estate, private equity firms, and obviously family offices and so on and so forth are being the one investing heavily in this sector. To give an example, fintech startups, 246 in 2008, and 1,327 2017. Investments, 2.2 billion to 30. And as you can see, the compounded growth rate, quite high, 72.4%. So obviously there must be something in that area, offshore. Like I said, most of this is not to do with us on ground here. There's not much of that happening. And I'll talk about why it isn't. The key areas of focus, those are the bullet points I have there. Real estate transaction services. One of the ones that I find interesting, digital lending platforms that we can't. By regulation, we can't have it, but I'll talk about it later. Dealing with basically real estate owners and lenders, online real estate investment options. I think we have a bit of that now, that's evolving. And then investment in single family homes for institutional investors. The advantage. The one I actually found interesting was the E-RIT. That's the last point. Providing solutions that combine features of non-traded RITs funding. Now, crowdfunding is really what is driving a lot of these things. But there are issues in Nigeria that do not allow crowdfunding to happen. I'm not saying it's not happening in the country. I'm sure people do it. But for it to happen the way it should happen, there are regulatory barriers to that at this point in time. Like I said, what I'm trying to is that this business, in terms of really using digital technology, is, can you imagine if you're trying to raise 15 billion, just give an example, 15 billion, and you had a platform that can reach, I mean, let's even say 180 million, but there are maybe, let me even be conservative, 20 million people working that should have incomes. At 150,000 naira investment, how many people need to invest to raise 15 billion? 100,000, basically. And the whole idea of crowdfunding is that small little bits of money from a lot of people makes that big chunk of cash. And that is exactly what's going on in these sort of these sectors. So for instance, if you look at what's going on, that third point, global online lending expected to grow 40 billion in 2016 to over 1 trillion in 5 years. Yeah. In fact, let me call it a peer group of mine in our industry is already funding a peer-to-peer lending business. Yeah. So my dear friend Sean might be and decide, you know what, I have maybe 5 million liquid on there, and I'm willing to lend it at, let's say, I don't know, 17% or whatever it is. And then there's another person that logs on, all right, and then borrows that money from you. You get, and then what they do is it's like a platform, exactly. That's taking business away from what? That's again a disruptor to the sector, because traditionally it's banks. Now we're saying, you know what? I'm not paying banks anymore. If I've got liquid, I go on a platform, log in, and say have money. But again, the question I had about that was, okay, how do you protect the lender? All the sort of things, you have to have all those things in place, and so on and so forth. But I'm sure they will come. They will come. Like I said, these are things for the future, but it's just telling you where the thought processes are going. I don't think, for instance, the traditional commercial bank will be exactly what it is today in 10 years' time. Absolutely not. Any bank that is thinking it's going to be like this for 10 years will be dead. No question on my mind. So there will be a lot of change over the next 10 years. Most of us will be dinosaurs then, but anyway, we'll still be there. So this diagram here, or this chart here, was just to show the growth of startups. Like I said, overall tech startups, was 1,372. Fintechs, 177. And that fintechs were able to get in that period 1.4 billion dollars in terms of capital startups. And that just gives an idea of some of the big guys in the industry, Money 360, Cadet, Realty Shares, and so on and so forth. I left those names so that if people want to check them out and see what they do and so on and so forth, and see whether you want to, you know, try and replicate or whatever, then those names are there to look for. How to benefit? My view was that fintechs, like I said, they provide those platforms, which again, diversify lender base, significantly do that. Today, for instance, at least in the States, traditional lenders have tightened a lot of their standards because of what happened in 2008. So there's, you know, a lot of standards. There's been a lot of tightening. You know, the whole Dodd, I can't remember his name. You know, regulations and so on and so forth. Things have changed. I mean, commercial mortgage-backed securitization, CMBS, for instance, right, used to be one of the best ways of financing commercial real estate. Again, that has been tightened because of the 2008 issues. Now, with Trump coming on board with his whatever, who knows? That may change. Let's see. Where should they start? What I talk about here is, you know, it's one thing to look at fintechs from afar, use their service. It's another thing, for instance, like a real estate developer, to actually want to be an investor in one of them, which is what I mean by partner. If you're a developer and you can now partner with a fintech that has the platform to actually raise funding for you, what are you doing now? You're beginning to cut out banks. I mean, if you could actually think about it for a second though, if we could actually crowdfund a development, everybody gets their money and a fantastic return, what do you think will happen? Thank you. You see, so by then, the presenter has come to beg you, show me business, I want now. You know? So this, I mean, there's a lot of things that will change. Like I said, see construction, real estate developers, owners, investors, using fintechs, okay, as platforms for all these things we're talking about. Leasing, acquisitions, disposals, etc., etc., etc. I gave this also example there, that Access or Access Plus Re, providing cloud-based services for valuations and so on and so forth. I just kept the names there just to make sure that for those who are interested, those that you have some sort of, what's the word? You just have a reference that you can actually go check them out. Check these. Again, same thing. This one, it's more or less the same thing. I've just talked about this, partnering with them, where I'm saying that owners can partner with startups. I don't know if this has a light. Does it have a light? No, I'm trying to. We know those pointer things. Was that one? I'm not sure. Maybe it does. Oh, there it is. Thank you. Okay. So, what I wanted to say was that owners can partner with startups to finance projects and, you know, so on and so forth. And I understand that this company here, Kadera, about 133 million of funding, on a platform that helps connect owners, operators, and investors. That was there. Meaning that owners of real estate can partner with startups, and the fact that Kadera, which has about that amount in funding, is one of those platforms that helps. So I'm leaving all these names so that you can look up these things. And then, of course, companies that have a fair understanding of the startup business with substantial funds and appropriate risk can also invest in fintechs. You know, there's even talk about setting up a fund specifically for tech companies. That's something that's actually in the works. Okay, in terms of alternative funding, this is just giving an example. Things that are happening offshore. This is Netherlands, for instance. This company, which I can't pronounce the name, Boner, whatever. Okay, again, uses crowdfunding as a basis for financing real estate projects. The same thing, you know, I just give examples. Brick Fund, the same thing, offers a method, you know, of investing in real estate. You know, again, some sort of blockchain technology. And again, what's good about it is, in this case here, users are further empowered to make their own decision and can invest starting with just, what, 5,000 euros. I think the last one, they can invest as little as 200 euros. So that's the whole idea. So it's just putting small monies in projects, monies that you can afford to say, if it will kill me, but it's worth. Thing with the one, it's all crowdfunding platforms. However, this is where we as Nigerians come into the matter. So we've spoken the English, we've gone to America, Netherlands, and so on and so forth, but we are now back home. Karma. For those who are lawyers, you know what karma is, right? So, as the legislature will say, Section 32 sub 2 provides that every private company shall, by its articles, restrict transfer of its shares. That's number one. Two, Section 22 subsection 5 prohibits crowdfunding in the actual sense, because it states that a private company shall not, unless authorized by law, invite the public to subscribe. And that's effectively what you're doing when you talk about crowdfunding. All right? It's creating a private entity or platform, whatever you want to call it, all right, that actually invites the public. By our own law, once you're doing something public, it must go through what? It must go through the rules of SIC. Exactly. And then you also have sections 67 and section 71 of ISA that also says companies intending to go to the public must, if you're going to raise capital, you have to file the prospectus. Okay, so you can see that there are issues. So these are the reasons why crowdfunding can actually happen in the country at this point in time, at least in a real sense. It cannot happen, at least not in any form, fashion. Now, there's some good news. My colleague, Chuka Iseka Vativa, worked with a team of other guys, lawyers, etc., who were commissioned by the Securities and Exchange Commission to work on revising CAMA and also ISA. And I'm aware that these sections they're supposed to have been revised. Okay, so there's a possibility that this may take off if that should happen. Now, how long that would take, and whether we have the money to pay for the funding with the with the what do you call them, senators and legislators and whatever, whether we have the funds to lobby the matter is another matter, as we always have matters in our own matter. So, like I said, we're bringing it back home. So, I said after the English, let's come to what we are actually doing on ground that we think, and that's why I said it kind of aligns with Kevin was saying. I mean, and I'm happy that we've been saying it for a long time that the real estate market is the big elephant in the room that nobody seems to be seeing. And like you've said, Kemi and etc. will go out and talk about SMEs. Of course, they're just repeating the language of IFC and the World Bank, MSMEs, SME, SMME, MME. You know what I mean? But the real thing that drives an economy that have built economies, okay, is the real estate market. I sometimes it's frustrating sometimes because you guys, can't you see? But those are the issues, and we at least Ngozi kind of got it. And that's what set up NMRC and so on and so forth. I'm hoping that, I know that Kemi, she's working on this family homes fund. I'm aware they're looking for an MD right now, so hopefully they can get someone that actually understands it and can, plug into the whole ecosystem that we're trying to create. Anyway, like I said, right now, Nigeria has a very, very low, sorry it's a bit small, low mortgage to GDP ratio, quite frankly negligible. Deposit base for mortgage banks very low. Most people don't put their monies in mortgage banks for reasons. Funding, of course, is expensive, and of course, there's limited housing supply. These are the issues we're grappling with. And of course, I add Kevin's point, titling is another point. Those are key things that we're grappling with. In resolving this, from my perspective, I always believe that we all have to solve things from different perspectives. So I'm happy that PwC is working on the titling with Lagos, right? I'm aware of that anyway. I don't know if you know Kunle or Motala. Yeah, they told me about this about a year ago, that they're actually working and they want to make it happen. And I hope they're able to scale, the dreaded civil servants. So I'm sure they will, because Ambode is a tough dude. But from this area here, what we try to solve is the demand side. So basically, the top, which is NMRC, deals with long term. What that does is that it guarantees the fact that a mortgage bank can easily originate a 20-year mortgage. No issues. And if our dear sister, Patricia, our DMO, if she was to lengthen the curve, what I mean by the curve is the Nigerian bond yield curve or whatever, from 20 years to 25, we would move the mortgage duration to 25 years. The reason for that is because NMRC funds mortgage banks by issuing long-term bonds. So that way, the mortgage bank's liability, which is the loan from NMRC, 15, 20 years, will match the asset, which is the mortgage. Then the institution below is there to provide short-term financing to the mortgage banks. What that institution does is that it actually, rather than issuing bonds, it issues commercial paper. Commercial paper is short-term paper under 270 days and below. And it uses the proceeds of that short-term paper to fund the origination, to basically, it lends it to a bank. So let's say, for instance, let's say Darpon wanted a mortgage, and you went to X mortgage bank. It may not have the actual cash. It would underwrite that mortgage, then it will bring the mortgage to mortgage warehouse. Mortgage warehouse would then fund from the commercial paper market and use that cash and lend it to the bank. The bank will then fund your mortgage. So your mortgage is done. You now have a 20-year mortgage or 25-year mortgage, right? Against a, say, 6-month liability, right? Now, the question will be, how can you have a 20-year against a 6? Now, that's where the relationship between these two dudes comes into play. Because then there's an agreement between the two of them that says, so long as the mortgage that is funded by you is underwritten under my standards, I give you an unconditional agreement that I would offtake that mortgage. Exactly. So by the time this 6 months, which is by NMRC's standards and requirements, is required, so by the time you spend 6 months on the books of the mortgage bank, it is now ready for what? Refinancing. Exactly. At that point in time, the mortgage is presented to NMRC. NMRC issues this long-term paper. Then the proceeds of the bond is then used to pay off who? The guy who invested in the commercial paper. Voila. All under a AAA structure. So hopefully this would help heavily with sorting out the demand side. And then you have something that looks something like this. This is what the ecosystem we end up looking at. So here, this is the money markets, right? So that's commercial paper issuance. These are the banks, or this is mortgage warehouse funding. So basically, like I said, it issues commercial, gets cash, pre-finances the bank, right? Mortgage sits on the bank for a while, then it gets refinanced by NMRC, who issues bonds and uses the cash to refinance it. That becomes effectively the ecosystem of the Nigerian mortgage market going forward. Pardon? How? Oh, totally accessible, because let me give an example. No. Absolutely not. Let me not say about but anyway, the truth is, the way we've designed this, both NMRC and MWFL, is that it's a member mortgage bank structure. So what you find is the members of NMRC are the same members of Mortgage Warehouse, right? So they would do their business in the ordinary course of their business. Anybody comes in and gets a mortgage, all right? What it does is that the only question that it begs is, wahala interest rate. Okay? In other words, interest rates are high. Now, like, sorry, I sometimes should be, moving around. Like Kevin said earlier, this is very true. Have there, as I said, just construction, at least, that it creates. Typical homeowner, typical renter, by a multiplier of 45 times in a lifetime achievement scale. I'll come back to interest rates, but the problems we're dealing with is have a very low mortgage to GDP ratio, and of course, the primary bank deposits very small, 300 billion, nothing. Now, interest rates. One of the things we are also canvassing to help reduce interest rates, and the people that I'm in the ring with are the pension fund managers, and Jaguar, but we'll win. I'll explain. So, today, for those of you who are contributing to your pensions, you have Fund 1 to 4. Am I correct? Thank you. So, we proposed, and this idea came to me some time ago, and it's caught, but we'll see what I'll get to the end. So, I proposed that we create a Fund 5, an additional fund, and we call that the Housing Contributors Fund. It is your money. So let's assume that you contribute 100 naira to your pension fund every month, right? Rather than the 100 naira being distributed across your Fund 1 to 4, it's now 80% to your Fund 1 to 4, which Fund 1 to 4 is they buy the bonds, whatever they buy, okay? But the Fund 5, that 20% goes into a Fund 5. That is your contribution. And then the instruction is that lend that money out at no higher than 5%. I want you to think about it. So you have 100 naira that you contribute every month, 80 naira invested in whatever you want, 20 naira put it in my housing fund, all right, and invest it in housing securities at no higher than 5%. Let's assume the cost of funds to Mr. Mortgage Bank here is 5 or 6%. And he adds 3% on top as his spread. What does your mortgage rate come to? 8, 9%. Thank you. Who's funding that mortgage? Thank you. My pension fund brother said, no, you are subsidizing. That means you are subsidizing. I said, you cannot subsidize yourself. Okay? No, now, think about this. So that's the first thing that, so we don't carry on rich VP matter. Anyway, so the issue now is, okay, how do I ensure that we don't end up like NHF? Thank you. So what we said is this. If we take 20, today we say the pension funds is about what, 7-ish trillion? Let's call it 7, all right? If we made it mandatory, okay, with an opt-out, because for instance, Sean can say, I don't need a housing fund, I already have my house, so I'm opting out. So you have the right to opt out, okay? Now, but let's just, for mathematical sake, assume that everybody stays in. That is immediately 1.4 trillion available to support, right, the housing market. I'll be 20% of 7 trillion. I won't call it. Thank you. Now, also remember, then let me also say another thing. We now also went, so we now said, okay, pension funds will say, but why should I be investing 20% of what I'm receiving into 5%? Because it's reducing my yield because of their fee. I now said, bro, Maslow's hierarchy of needs. What does everybody want? Formal, informal, whatever sector you want to call it. I need to eat, I need to clothe, and I need shelter. Okay. The informal sector of Nigeria is approximately 80% of our labor force. They don't contribute shishi into your so-called pension fund. Why? Because they don't see the benefit. So we now said, guess what? If I go to, in fact, let me see now. This cameraman looks like he's self-employed, I mean. Thank you. So if somebody came to you, sir, and said, for the amount you earn, the money you earn, yeah, you qualify for you can buy a house, we can give you money to buy a house, whether it's 5 million, 6 million, whatever the value is. And it's going to be at 8% interest rate, yeah, much lower than whatever. And the only condition is that you're going to contribute into your pension fund, whatever that the actual amount is. Would it be interesting to you? Why? No, let's hear his point. Why? What's too much? Is it the house value? No, let's say it's a house you can afford. Forget about the value. It's something you can afford. Okay? You can afford it. So rather than pay rent to somebody, it's somebody that you now your own house and you go to pay them small. Make I break this into broken so we understand that matter. Okay? So now your own house, you they pay them small. And the value, whatever the value be now your own value. Okay? And it also say to just collect this house, small money, whether not even a 10 naira self they put for your pension. So that when you self-retire, you will get small money again. It will switch you. You know, sometimes I have to go to broken to understand the matter. Okay? But the point I'm trying to make basically is that if you go to any informal person and say to them, right? Whether it's Anton Tajani, whatever, I'm giving you the opportunity to own your own home, right? At an interest rate that makes sense, affordable, all right? And the condition is you pay your small contribution. Even if you only get, I'm just saying, 10-20% of that informal sector, yeah, you would significantly increase funds under management. You see, so that is part of the things we're trying to do to get the cost of funds down. Of course, if interest rates in Nigeria should ever drop to single digit, then you don't need that anymore. Exactly. But the beauty about it is that it's actually sustainable and it can work. And it's one way of actually galvanizing the sector, both from the construction side and also from the demand side. So there's a lot of work being done. We hope that once at least our generation have been able to put things like this down, then the younger generation can move to the blockchains and the software and so on and so forth. So thank you very much.
Thank you, Mr. Ayere, for that insightful presentation on alternative financing in digitally enabled market. At this time, we'll be welcoming questions. However, in the interest of time, we will limit our questions to just 2.
Good morning. My name is Abdul Malik from Brains and Hammers. I just want to share our experience with exploring alternatives and NMRC in particular. And I'd like to start by thanking you for the kind of missionary zeal you have in solving the issues, because most of the focus has been on helping the banks, the mortgage originators, when nobody's talking about the off-takers. Because as long as the off-takers cannot afford these mortgages, whatever truancy we speak here would not solve the problem. So we're trying to do a pilot scheme in Abuja. We have a 3,000 city, we call it the Brains and Hammers City Estate. So we put 100 houses in a scheme we call Dream Homes in partnership with Imperial Homes and NMRC. NMRC will refinance eventually, and we say we'll do zero equity contribution. Of course, no salary domiciliation, just to reduce the barriers to entry. And we peg the prices at something like 15 million for 2-bedroom, 20 million for 3-bedroom, and 27 million for a 4-bedroom terrace. And these houses are actually ready. So you just plug in today, start making your repayments, and as soon as the seasoning period is over, NMRC Refinances will give you your key. But what we found out is that so many people, bankers, people we thought, could afford to take these houses, and the fact that the house is ready, you can see it, and you can actually sack your landlord in 9 months, but people just can't afford it because of the rates. The rates are so high. Typically for a 2-bedroom, you need to pay about 254,000 naira monthly. So these barriers to entry, while we're working on this 5th fund, even what we have now, we can make it more efficient. As little as the repayment calculator. And these mortgage banks, especially PMIs, they are not interested in solving these issues. So you bring NMRC, they look at you, okay, why don't you empower NHF? Why don't you correct what is existing? You are bringing a new thing so that some people can eat and all that. So there's resistance to that. So they are not participating in finding the solution. They are not helping you go along to find this 5th fund. They are okay where they operate. The PMIs, in fact, they are not as well regulated as commercial banks. That's number one. They are not. They're somewhere in between. They're just hanging. It's not FMBN that is regulating them. It's not CBN that is regulating them. So they get away with a lot of things. You find PMBs that you cannot even withdraw your money from. Your own money, you can't withdraw from them. The 10,000 naira, you go 3 weeks, you'll be going to come back just to withdraw 10,000 because they are not funded. Now, so let me give you an example now with repayment calculator. The repayment calculator that they use in commercial banks for mortgages is quite different from what they use in PMIs. So for example, in a commercial bank, the banks that we use, Sterling Bank, Jais Bank, GT Bank, they divide the principal by the tenor. So 20 years, your principal 20 million divided by 240, straight line. And then the interest will be, of course, reducing balance. And then you can just divide the total over 240 and to get the EMI. If you go to a PMI, you find out that for the first 10 years, you're just paying interest. And the difference between, for these are dream homes now, for a 20 million naira house, the difference between the annual repayment for 1 year is about 1.5 million. So significant. And that 1.5 million can automatically take you up from a 2-bedroom in terms of the affordability scale. And I sit down with these guys and say, this thing is not your money. It's NMRC's money. NMRC says they can do this repayment calculator because we brought the 2 repayment calculators. This from GT Bank, this from Jais, this from Sterling. These are commercial banks. And they are willing to do this. And then when you want to exit, no penalty. These guys say, but we're going to reduce the money that we're making. Are we trying to solve a problem, or are we trying to make as much money from this guy that cannot even afford it in the first place? So you get a lot of interest. People call you, 500 calls in just 2 weeks. We want. Everybody wants to buy a house, joint mortgages, husband and wife. But once you just give them repayment calculator, that's just the end.
And this is 20 years?
This is 20 years, and these are bankers, people that work in, pension fund administrators, people that work in NGOs, people that typically cannot get loans from commercial banks. Because when you go to a GT Bank, for example, and you work in an NGO, they look at your contract, it's 3 years. They will not look at your working life, the fact that you've worked in these 3-year contracts, you've been doing it for the past 12 years, from program to program. Because development work will never finish. Because as long as Bill Gates is still coming, there will still be money. So they just look at 3 years and just tell you, your contract is 3 years, so I can't give you a 20-year mortgage. But okay, the PMIs can do it, and they want to do it, no salary domiciliation. And we try to talk to them, this equity contribution. Say, this equity contribution, I'm the developer, it's my money. I say, I don't want this 30%. Let these guys just start paying. And I have the house. So we now said, okay, just the house is ready. It's at roofing stage. We've put windows and everything. We've not finished. Let this guy start paying for 6 months without equity. And by the time they reach 6 months, whatever they've contributed in those 6 months, NMRC is saying that, we'll look the other way. It's not a problem. That's their equity contribution. It doesn't have to be 30%. It doesn't have to be 20%. As long as the guy has shown capacity to service his facility. So these are the, before we get digital, like you said, these are the things that we can do to remove barriers to entry, increase efficiency, and get these things done. But the mortgage warehousing is only financing mortgage banks, and these mortgage banks will still come back to you and tell you 25%. So it will never work.
No. Okay.
As it is,
No. You know, I hear you, and I hear the complaints, and these are the issues that we've been dealing with. Let me start with the offtake, right? The whole idea of the web is actually that it actually becomes an offtake vehicle for developers. Because one of the things that it actually will end up becoming is that it would have developers on its books that are pre-qualified, and the intention is actually to have agreement with certain commercial banks such that if you finance their development, right, we're giving you an offtake that we would offtake those properties from you via mortgages, of course. Now, the interest rate, I mean, when NMRC was being designed, we had the option of designing something that looked like, what's the word, that's subsidized. Because the $300 million that the World Bank brought was, you know, give you $300 million, you go and raise $300 million, $600 million. So if I give you $300 million at 0 interest rate, and you raise $200 million at 15, I'm just giving an example, right? You can do a mortgage at 7.5. Yes? But then the question then is, what is $600 million in our market? It's vapor. It's not even a drop of water, it's actually vapor. That's exactly what I said to the guys in the World Bank. Makes no sense. I'd rather give me that $300 million, let me leverage it. Even if it's 10 times, it's $3 billion. I'd rather do that. If I could leverage it 20 times, it'll be, whatever, 20 billion, whatever it is, 6 billion. Anyway, the point basically is this, is that we can't control interest rates. I can't, and I cannot tell Godwin, dude, drop this thing. I can't. That's his decision. One of the biggest problems we have, again, in our country is if I assume this side is the fiscal policy and this side is monetary policy, right? They are totally at loggerheads. I can't understand it. I mean, it's the kind of thing that I would have sat down and said, dude, okay, Godwin, Kemi, if both of you don't find a way to work together and have a harmonized policy, I'll fire both of you. I get 2 people that can work together. But then that's another matter entirely. So I don't have control of interest rates. But what I do have control of is creating something that I know is sustainable, can work, and continuously work. I give an example. Tanzania Mortgage Refinance Company today, right, is all but dead. Why? Because they didn't have to say, this joint thing, when the money finishes, what happens? Then you go cap in hand again back to World Bank. Can we give another one? I mean, really? That's not us. So, truth is, if in the fact that we cannot control rates, what we've tried to do is come up with innovative ideas in how we can, you know, bring it to something that's a bit reasonable by also using the monies of people who are contributing. That's one. In terms of your question with respect to the way mortgage banks calculate risk, the truth of the matter is, how do I put it now? The repayment structure looks something like this. The interest goes down, yeah? It starts high and then goes down. The principal starts low and then goes up, right? But the amount you pay is the same. That's how it works. And the reason is because in the event of a default, and always remember, the loss curve for mortgages are generally front-ended. Most people that would default on a mortgage would default, generally speaking, within the first 24 months. So if you are taking that principal, like you said, I will be taking a big principal hit. Whilst if I'm getting that interest cover, right, and I'm just receiving interest, very little principal has been paid, okay? If I'm able to now, what's the word, get the property back. I don't want to use the word, foreclose on the property, exactly, right? And because you also have, and that's why the loan to value is very, very important. I won't advise you to do what you just said you want to do, which is, don't pay anything. All right? That was what finished the US market. Right? And I was there, I knew what happened and how it happened. And there are quite a few films now that tell you what happened. The truth basically is, it's a normal human matter. If I buy a house, I move into a house, and I have no skin in the game. If things get difficult for me, I'm walking out. No discussion. And I'll leave you just high and dry. If I buy something, I want you to think about it. I bought a house, I just want to use a number that gives some significant sense. I bought a house for 100, and I put in 30. Okay? No matter how hard reach, I will fight to try and get some of that 30 back. Even if I don't get all of it, but I will not walk away from 30 million. And there's some people that will not walk away from 3 million either. But if I have to put nothing down, I will just pack my bags and leave. And that's what happened. And that's why never, ever do 100% mortgages. And when you do even 90, you always make sure you have a mortgage indemnity guarantee to protect you. Just normal human behavior. It's normal. It's not, the guy ain't crazy, the lady ain't crazy. It's just, look, things are tight. What's my tie to this place? Nothing. Why am I killing myself with letters and stress and whatever? Okay, pack, do the thing. So, we can't profess to solve all problems at this point in time. Like I said, we're doing what we can to tell you how difficult it is. Even mortgage warehouse that we're talking about, all right? We've only just gotten sort of green light to, go to different, houses and sell. And that took us almost 6 months of, playing ping pong. And then after that, once you finish that, we now have to start the wahala of how do we get interest rates, to something that's reasonable if, the monetary policy people don't begin to bring down rates. Okay? So I understand the frustration, but I would say that by all means, tens, whatever I can think of, it's going to be a very inevitably people will, I've always said one thing, that one of the reasons why interest rates is not on the political agenda is because most of the economy are not linked to the rate. By the time everybody starts having some form of mortgage, whatever, like I was said, people say they're fighting corruption. Sorry, I'm bouncing around a bit. But people say they're fighting corruption. To my mind, if you don't have a pay as you earn structure in an economy, you have not started the first fight against corruption. Because the truth is that most of us get paid monthly. By the end of the year, somebody has to pay rent of 2 years in advance. No, these are the real issues. If you don't create a pay as you earn structure in an economy, there's no how. You have not started the fight against corruption. Because people have needs, and those needs have to be paid in bulk. How do they find it? Where's the savings coming from? And salary structures are low. So those are the things I talk about that also need to be put in place. Okay? So let me stop there for now, and we can talk one-on-one later. Don't know if any other questions.
Good morning, everyone. Thanks for the presentation. I'd like to talk about the crowdfunding because I believe that this is a great opportunity for Africa to finance especially social impact projects, and I think it has proven effective, that model, to finance small projects. But that's where the issue I'm having right now, because it's been effective for small projects, but is it actually possible to raise a certain amount of capital for a real estate project? Because we know that real estate development project, generally you will have to invest like a large amount of money, a large amount of capital to have those kind of real estate developments. Is it possible actually to develop a model based on crowdfunding
to finance those kind of projects? And do we have actual instances where this type of project has been financed through crowdfunding?
Thank you. It's a good question. And luckily I have at least two developer friends here. I have Joe and I have Damola there from Alpha Me Development. They can sort of give, in terms of size of projects they do. But the thing is, to go straight to your question, is it possible to fund real estate development through crowdfunding? Absolutely yes. Any real estate developer will tell you that what I'm looking for is patient money. Am I right? And when it says patient money, money that can stay with me for maybe what? 2 years? 3 years, let's say. Right? Now, we're looking at something about, say, this 3 billion naira to do the development. Like I gave the example earlier. I said, for 15 billion naira, yeah, I said, what was it? It was 150 at 100,000 people. Now, if somebody puts in 1.5 million, I've already taken out 10 people, assuming the minimum investment was whatever. For a 3 billion, right, which is to build like normal residential homes, that quantum is going to be much smaller. So to me, what is actually most important is having a platform, the platform that reaches people. Now, how will that work? Off the top of my head, imagine a platform that was linked to subscribers of MTN. That's 50 million subscribers, straightforward. 10% is 5 million. I mean, just think about it. Even if I just said 10K a month savings, I want to put it aside and invest it in projects. I can't do the math here, but 10,000 times 5 million, what do you think that is? Who's the mathematician here? 5 billion, 50 billion? 50. Thank you. A month, by the way. A month. So definitely it can be done. What is stopping it right now? Like I said, regulation. At least at that level, that scale. I'm sure there are pockets of it happening. There's no question about it. It's happening. But for it to become something that can be scalable, probably have some level of regulation, have something that gives it, gives investors comfort, we'd have to, overcome that CAMA 22.5. But it definitely can be done. No question about it in my mind. And one of the things, like what I would say, take a country like Nigeria. Our strength is not oil. It's not gas. It's population, which is why that, the guy that came last to the foundation guy, Bill Gates, was saying that, look, you guys need to invest in your people. The truth is that we have that population. So you can see, just as you just said, 10,000 naira, 5 million people, that's 50B. Lagos State doesn't earn that a month. Think about it.